It's become a running joke that when I walk into a television newsroom, the anchors groan. Oh, Brad's here again. The market must be down. That's because they only call me when the market is cascading and viewers are freaking out. I do offer to pop in on a good day with equally beneficial advice, but so far, that hasn't happened. Unless you've been properly planning to be prepared for a market correction, a bear market, a recession, you may react in similar fashion. There's something called loss aversion, which is one's tendency to prefer avoiding losses to acquiring equivalent gains. Studies have suggested that losses are twice as psychologically powerful as gains. This means losing $500 would hurt more than winning $500 would make you happy. I know it seems weird. So it should come as no surprise then that many investors want to make changes to their portfolios when the market is closer to a bottom than a top. However, selling low and buying high is not a strategy that's going to make you rich. Here's what you should do instead. First, realize downturns are not rare events. They happen a lot. According to Vanguard, since 1980, there have been 19 corrections, declines of 10% or more, 10 bear markets, declines of 20% or more for at least 2 months long, and 6 recessions, which are declines in economic conditions for 2 or more successive quarters. We've recovered from all of them. Second, if you're feeling that urge to sell and move everything to cash, speak with a financial professional first. A CFP is a good person to seek out. Yes, there are cases where raising some cash may make some sense, but moving to 100% cash increases the likelihood of you missing out on a strong recovery that typically follows market downturns. If you had missed even a handful of the best trading days over the past 20 years, you would have severely underperformed the market as a whole. 2020, COVID-19, remember that? The pandemic sent the S&P index plummeting, but had you endured, you would have most likely made money by year end. Third, devise a game plan before the next market pullback so that you'll know what to expect and your portfolio will be prepared. For example, if you depend on your investment accounts to supplement your income, perhaps you can begin creating a cash bucket beforehand so the next time the market falls and you need money, you won't need to sell anything. That would likely relieve some stress. Really, it's about focusing on what you can control. Assess your investment risk tolerance, diversify your assets according to your risk and your time horizon, and pay attention to the costs of whichever investment vehicle you're utilizing. The bottom line, market downturns happen. Fortunately, they don't last forever. With proper planning, you'll be able to ignore the short-term pullbacks of the market and remain focused on your long-term goals. And maybe someday I'll share this positive news with the news anchors.
Have you heard